Hey, what's up guys? John here. Many people know that commercial real estate is in very big trouble. A lot of people are looking at regional banks, thinking regional banks are in very big trouble, but no one's looking at what BlackRock is doing behind the scenes. It's going to impact everything and everyone. And I'm going to break it down for you with clear, verifiable facts, showing you the FDIC website, showing you what they're saying, showing you the true state of this market. The media is not letting anyone know what's really happening. They're painting this fake image that everything is okay. We're going to have a soft landing. There's nothing soft about this landing coming. And I'm going to break it down for you. Please hit the like button. YouTube will share this content to educate other people about what's really going on. And if you want to fix your credit, you want to position yourself for the greatest wealth transfer of all time, I'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, anything, go to GreatCreditFast.com. Schedule a free strategy session, see how we can help you. One late payment will sit on your credit report for upwards of 7 years and drop your score a whopping 180 points. Don't let that happen to you. Don't let one or a couple items get in the way of a bright future. Go to GreatCreditFast.com by clicking the link below this video inside of the description. Take a look at this. So this is the FDIC website. FDIC announces start of the marketing process for a $33 billion commercial real estate loan portfolio of former Signature Bank. Washington. Today, the FDIC, Federal Deposit Insurance Corporation, announced the start of the marketing process for approximately a $33 billion commercial real estate loan portfolio retained in receivership following the failure of Signature Bank. Like the majority of the CRE portfolio being marketed is comprised of multifamily, primarily located in New York. So basically rent-controlled property, right? Rent-stabilized, rent-controlled. Meaning that these properties, you aren't able to increase the rents. You're not able to kind of force appreciate these assets in most cases. You're basically going to buy them, and then landlord-tenant laws are going to get much, much worse. There's going to be a smaller pool of buyers wanting to take on that risk in this environment, and these assets are going to continue to erode under higher interest rates. So all this is happening, and I saw this on Twitter. Said I heard no bidders for Signature Valley, their portfolio, right? Signature Bank's portfolio. 33 billion, dropped the price to 16 billion. They dropped it 50%, right? 50%, still nothing. Nobody wants it. Nobody wants it. So how is this whole thing going to pan out? Well, look at this. So FDIC and statutory obligation, among other factors, to maximize the preservation of the availability and affordability of residential real property for low and moderate income individuals. To support this obligation, the FDIC will place the rent-stabilized or rent-controlled loans in one or more JVs, joint ventures, with the FDIC retaining majority equity interest in the JV. In addition, the JV operating agreement will provide certain requirements to facilitate the financial and physical preservation of these loans and underlying collateral, while the FDIC will retain a majority equity interest in the JVs. The winning bidders or partners will act as the managing member of the joint venture and will be responsible for management, servicing, and ultimate disposition of the loans. The JV partner will be required to manage the portfolio according to the JV operating agreement and subject to stringent monitoring. Who would want to do that deal? Who? Nobody, right? That's why they're dropping it. Well, no one at this price, $33 billion. Now remember, this portfolio, this $33 billion portfolio, probably valued when interest rates were 4%, right? 4.5%. You know, this bank fell about 7 months ago, 6-7 months ago. That was many rate hikes ago, right? The rates back then were completely different than what they are now. And rates are going to continue to likely increase. And I think a lot of investors are aware of this. And so as they start to put these new requirements on, I would not be surprised to see this number drop from 16 billion to sub 10 billion. I wouldn't be surprised at all. So banking bonanza. BlackRock goes after lucrative deals, right? BlackRock capitalizing on a banking sector in flux. With an unflinching eye on the unfolding turmoil, BlackRock is primed to increase its buying spree. Vice Chairman Gary Sheldon, a seasoned player in the financial field, spearheads the strategy that positions BlackRock funds as capital reserves for banks wishing to unload asset-backed securities or extensive portfolios of various loans. The market is certainly not lacking in options as lenders scramble to find willing buyers for their assets. They're getting ready. While the increased pace for loan sales suggests a level of desperation on the part of the banks, Sheldon views the situation as a manifestation of a broader long-term trend where private capital becomes more significant pillar of support for lenders. The BlackRock strategy, according to Sheldon, isn't just beneficial for the company, but presents a golden opportunity for its clients as well in its pursuit of bank assets. BlackRock is considering the launch of a new investment vehicle specifically targeting this sector. However, it's not alone in the pursuit, with private equity and credit managers jostling the claim to their piece of the banking pile, eyeing the banking distressed assets, right? We know that this is going to happen. We know this. But it gets crazier. It gets a lot crazier. So the banking industry has been withering under multiple pressures. Banks are dealing with money market funds, exciting depositors away with the more appealing yields, grappling with asset liability mismatches. Additionally, certain assets such as commercial real estate loans are teetering on the brink of danger. BlackRock CEO Larry Fink has recognized these mounting pressures as revealing cracks in the financial system reminiscent of his previous financial crisis. In response, BlackRock has attempted to seize the initiative by taking part in bids for distressed banks, signaling the intent to capitalize on the situation. At the same time, regional banks in the U.S. are scrambling to shrink their balance sheets in the face of aggressive interest rate hikes by the Federal Reserve, which have undermined the value of some of their holdings. So, we get an idea of what's happening there. Now what we're looking at is this very interesting picture where now these newly unveiled banking regulations wouldn't have prevented this year's bank failures. What they're doing is they are going to increase the amount of debt that these regional banks have to hold. So this is going to be in the form of a security, so this will help in the event of bank failures. But what this ultimately does is increase the expense for these banks to stay in business. So their commercial real estate loans are in very, very big trouble. A lot of their auto loans are in trouble. A lot of their commercial loans are in trouble. Residential loans are in trouble. A lot of their depositors are pulling money out of the bank. Simply, people are just running out of money. And so these banks are just sitting on one loss after the next. Meanwhile, BlackRock and a lot of these corporations, private equity firms, institutional investors are sitting on the sidelines with trillions, not billions, trillions of dollars sitting, waiting to pounce on these opportunities. Now, how is this going to play out? Banks will no longer be able to act as their own risk managers. Under the new rules, banks with $100 billion or more in assets won't be able to use their own models to determine the risk they've undertaken on loans and other activities. Their risk level assessment have been the basis for informing how much capital they'll need to hold as their baseline requirements. The new rules would force banks to use standardized models that is more conservative than their own in terms of assessing risk. Accounting for unrealized gains and losses. Banks would be required to factor in unrealized losses on gains and securities in the portfolios, right? How will this affect the consumer? Some officials who voted against the new regulations with the FDIC and the Fed cited concerns that it could significantly constrain banks' ability to lend to businesses and individuals. Some also expressed concerns that banks would pass on their higher capital costs to consumers in the form of higher fees to maintain their profit levels. The increased capital requirements could lead to an increase in interest rates for low and moderate income and other historically underserved borrowers that cannot afford 20% down payment. I've been warning about this, saying that the middle class is getting rug pulled. People really need to pay close attention to their credit. They need to put themselves in the best position possible. And I'm saying this because if you look at the GFC, the Great Financial Crisis, very similar things happened, except this time it's way worse. If you look at where consumers are, they're in a way different spot. If you look at everything is different. The average interest rate on a credit card back then was 12%. Now it's 28% average. You look at the average car payment. Back then, the average car was $7,900, used car in 2008. The average car today, the average car payment is $700 a month, over $700 a month. So you just do the numbers. I mean, just inside of, call it 12 months, 13 months, you could buy the car for the price in 2008, right? So you could literally buy four cars with today's average payments compared to the price of a car in 2008. Not factoring in for other inflationary costs. Everything is just going through the roof. Consumers are in really, really bad shape, and banks are in very big trouble. And some very unique things are happening as well. So this situation with this office residential conversions, people I think are downplaying the severity of this, but this is also going to put a lot more pressure on these commercial loans, a lot more pressure on these banks, because they're going to start to look for ways in which they can reassess and reposition these assets. So investors are going to come in and they're going to be taking on a much bigger expense to hopefully yield a bigger return on the end after they reposition the asset. But this is happening everywhere. And the White House, they're pushing to relax zoning laws to allow this to happen. You have, private equity firms such as KKR looking to reposition an entire mall. I mean, an entire mall, 1.2 million square feet, into 5,000 units. Think about that. How crazy that would be to live inside of a community. When I say crazy, I mean just think about how dense, how compacted. It would feel like you're living in a prison with 5,000 inmates with you, right? But this is what's happening. And that's my guess. I haven't been in a community with 5,000, but I think of a city like Hong Kong where they show you that skyscraper where it's everyone's stack and pack. It seems very similar, but 5,000 units. So what you're going to see here is you're going to see a lot of these KKRs, Blackstones, a lot of these funds looking to reposition assets and buy these assets directly from these distressed regional banks. And there's going to be many more of them coming in the year to come. And the reason for that, they're going to continue increasing interest rates, putting pressure on these banks. Consumers are going to get in worse shape. And more defaults are coming. More opportunities going to be coming as well for the smart and savvy real estate investor and entrepreneur that's paying close attention to what's going on here. What do you think about this entire situation? Drop below, hit the like button, add me on IG. And again, if you want to fix your credit, you want to position yourself for the greatest wealth transfer of all time, go to greatcreditfast.com. That's greatcreditfast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to greatcreditfast.com, book a free strategy session below, and I'll catch you guys in the next video.